Welcome back to the channel. If you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about THO Industries, ticker THOR, a 5.3 market cap company, and they manufacture and sell recreational vehicles or RVs, as well as related parts and accessories. So, first thing that we see when we look at the chart is that the stock has been in an upward trajectory since it troughed in late 2022. So since then, we are in this wide but pretty firm upwards channel that we see here. And unless this channel is broken, I think it will continue, we could see the stock returning potentially to the lows that we saw back in March this year when it reached $130. As you can see, it has fallen quite a bit to just 100, so it's down significantly since that peak. And why was that? Well, let's look at how this is played out year to date. So we start here at 120 almost, gets up to 130, and then drops massively after reporting earnings. So dropped right back to 100, and it had a bit of a pullback, and it's come back down to those levels. The reason for this pullback was likely because of the inflation headline that we saw, striking back fears of not cutting interest rates anytime soon. And as we see here, there's been a little bit of a pullback recently because of the comments from the Fed. The market has pulled up a little bit. But the bulk of what interests us is right here, this gap. This is definitely a big move. So what happened? Well, Q2 2024, the company lowered net sales and EPS guidance for the year. So obviously they had this initial numbers that they were aiming for that they would produce this year, and they came out to the market and say we actually not gonna hit that. So they have put together more realistic assumptions, more conservative assumptions that, for example, in terms of shipment range, is equating to about almost 6% decrease. But I think more importantly is that they decreased their gross profit margin assumption by 0.5%. So not only sales and EPS, but also margins, very, very important in a stock. Now, for this year, they also have expectations for negative revenue and earnings growth. So I'm just going to take you here very quickly to see that. So for 2024, they expect 525, whereas in 2023, they reported almost 7. So that is a 25% decrease. However, and this is quite important, we're not only looking at a whole year, we got to look at what the next few months ahead of us are telling us. And so what it's saying is that the last quarter was not a big weighting, but the next two, 183 and 229, certainly are. These two quarters are going to be reported in July and September. And this is why I think there might be an opportunity here. I'll elaborate a little bit more on that. But the point with this quarters here is that there are big numbers ahead in the next two quarters that will drive volatility in the stock. Okay, so let's go back to the chart. The chart tells us that the stock is currently trading at 15.5 times next 12 months earnings. So if we assume that multiple and take it to 18 times, that takes us to a price of $116. And from what we can see, that's not far-fetched because That's exactly where we were sitting back in March when we hit that high. If we look back a little bit more, we can see that the stock was also there last year around summertime, which is the timing that I'm expecting for this to play out. Certainly was not there over the 2022 period because the market was struggling heavily. But if we look at previous years, uh, it's certainly a multiple that the stock has been before. And so because of that, I am making that assumption as a bit of a ballpark. So at current levels of $100, we have a price target of 120. That's a 20% upside from here. And so we have to ask ourselves if that is reasonable because 20% move is quite a bit if we choose to play this with out the money options, which is the structure that I'm thinking about. I'll explain a little bit later how that works. But the calendar that I have in mind is going long September, which is 4 months from now. So I would be buying the September and selling the August. That gives me about 3 months from now. Citigroup has a price target for the stock at 120, and so do other analysts. So if we look at where we are vis-a-vis price target, we do have a bit of room to get there, and I think 3 months is certainly reasonable to achieve that kind of move. So I think September again will be the time when we might get to those levels. The company at the moment, if we compare it to some competitors, is in a bit of a middle of the road valuation. So what do I mean by that? If we look at how the company is priced at the moment versus competitors, let's have a quick look here. I have a few snapshots as a matter of fact. Okay, so this is the valuation on next 12-month P basis. I've selected Winnebago Industries, Lazy Days, LCI Industries, Camping, World Holdings, and Rep Group. All those as competitors on a next 12-month basis. PE. THO is middle of the road, so currently at 15.5, and we see that some competitors are trading at 16.5 and 19.3. So again, that goes to show how that 18 times multiple is reasonable. We also can look at this from the perspective of EV to sales. And if we do that, it's a similar situation, but actually we're getting very close to achieve that $120 price target if we apply a 0.8 multiple, which is certainly where some competitors are. Actually, 0.7 works as well to get fairly close. So that's another reason why I think there could be those kind of movements, or those kind of price target levels. And if we look at the price and volume, we can see that the $120 level is not the most active, but it's still fairly active. This is over the last 5-year period. And we are currently sitting here, which is one of the most. So we are making the assumption that we're gonna go from here to here and certainly not beyond where, because the volume has been historically quite low. On other areas, we have other things to look at. So short interest has peaked in March this year at 7.74 and has been slowly dropping since then to below 7. So to me, that goes to show that the investor community feels slightly better about the stock. We can see here how the short interest is dropping. Okay, so that's a bit of the sort of projections, market dynamics type of aspect, which I've focused on far. I'm going to talk about the financials a bit now because I feel there's a few things to pick up here. So the financials are a little bit mixed. There's good and there's bad. So for starters, we have negative revenue in 2023, where the market experienced, this sector in particular, experienced a heavy downturn. And we can see that their EPS suffered quite a bit. So it went from 20 to 7, and in the last 12 months is achieved 5. So that is definitely a big change. However, there have other things that we have to take into account as well. So margins have stayed over the past decade fairly flat, despite a substantial increase in revenue, right? So for example, in 2021, you had revenue increase of 50%. 2022, even though it was not a great year in general, revenue rose 32%. However, their margins have remained fairly flat. And so that means that there is an increase in S&A spending, and that growth for the company has become more expensive. So that is not a good signal when you look at the profitability prospects of the company. And in terms of their competitiveness versus the sector, I found this analysis here from Seeking Alpha, one of their articles. Here, there's an analysis about how they stand in their profitability. But the important thing for us to focus on is this chart here, which compares their profitability against their industry. And as you can see, in general, it's not great. Now that may be because some temporary challenges, could be for other reasons, but the point is that we are not getting an outstanding performance from these guys in that area. However, now not everything is negative. There are other things that we can pay attention to, and I think they could potentially outweigh the negatives. So the company doesn't have much debt. So if we look at the highlights, the total debt, that equates to 1.4 versus a market cap of 5.33. Definitely not high. And so that could be a strength here for this company. Let's not forget that part of the drop that we saw over the last few weeks was motivated by interest rates, but not necessarily because of their debt. I think this company could do well if we continue to be in a higher for longer environment. Obviously, we'll do better if the interest rates rise because their customers will have an easier time purchasing the products that they sell. But in terms of their financial position, they are not over leveraged. And as a matter of fact, they have deleveraged in recent times. and have also postponed the maturities of their debt repayment. I think it's until 2030. So that is certainly something that makes them stand out compared to, for example, one of their competitors, which is called, let me have a look here. It's called CWH. And I may speak about this company as well in a different video. So Camping World Holdings, CWH. Now these guys do have much, much more debt. So these guys have 4 billion in debt. This is a market cap of 1.71. So very, very different profile uh, compared to the THO. And that's the reason why I have selected THO as my long in the sector. Even though this company here has more bullish projections on revenue and earnings for this year. But there are other things that I think are a positive for the stock. So something that caught my attention is that they have plenty of cash available to them. So when you are in a position when you are reducing your debt and you increase the cash, so they have 340 million right now, and that is on a market cap of 5.3. That will enable them to um, to continue their share buyback programs, which have slowed down for a bit in a while. And if I was part of management or a shareholder, I think that would make total sense. The reason for that is because when you look at the yield that this company is generating is actually quite attractive. So they have an earnings yield which needs to be calculated in tandem with the dividend yield of 9.12%. That is very competitive versus treasuries, even in this environment. Treasuries are somewhere a bit above 5. I think it's 5.4 or just about. So 9.12 is actually pretty good. And that is at the recent level of $100. So obviously not as competitive if we get to higher levels, hence why I'm considering this as a long at current levels. And so if you are a board member or a shareholder, you have the option of deploy more excess cash on whatever, or you can just buy back the stock and get a 9.12% yield. I think that makes a lot of sense, even if we stay in a higher for longer environment. Now, let's talk about the market that is up, because North American RV wholesale market is expected to increase shipments by 11% in 2024. And at the same time, the management has been quite forthright on their expectations to make them more conservative. So we have management saying, okay, we're lowering our target in terms of what we expect to sell, but the industry association, which is called RVIA, these guys, which have a monthly report, says that the shipments are up 9% through the first quarter of the year. And February shipment shows an 18% increase in March. This is, by the way, one of the catalysts that I will keep an eye on as we progress over the weeks, because what I'm seeing here is an increase in the activity of sales in the sector. And yet, when we were here in this move, part of the reason why the move happened was because management stepped up and said, we expect to ship less less vehicles this year. So what if the market expectations are now quite low? And what happens is just that their initial guidance for sales was just going to be delayed. I think that that could be something that moves the stock big back into those levels and potentially beyond. Okay, so like I said, not everything is fantastic with the companies. I'd like to see better margins. Um, I have a few snapshots here that show how the margins have eroded over the years. So pretty flat for the most part. And obviously, as we start getting into the pandemic and then coming out, they get better, but then slow down. Let's not forget that this stock is fairly cyclical, right? Um, so of course, we will need a positive GDP growth environment for this company to do well. But at the same time, we are seeing that demand is there. Something that we'll keep an eye on as well is the attendance to RV shows in the industry, which from the information that we're getting from the company and also these guys here, RVIA, seems positive so far. But we'll have to keep an eye on that as well. So something that I think is positive is that the company is not blind uh, to what's happening. And when they made the announcement last quarter during earnings, they said that they implemented a disciplined operating approach in a softer demand environment that involves producing the right mix of products at price points aligned with the budget conscious consumer. And they're also working with their suppliers to identify opportunities where they can reduce costs. So even though they are experiencing a bit of headwinds in the sector, I think they're doing the right things. They're focusing on what they can control. Um, and and they do have interesting prospects. They continue seeing the market recovering at a good rate. So how is this going to play out? Well, we got a few catalysts to keep in mind. Like I said, interest rates is going to be a big one, and that's why I'm choosing a relatively long period for this to play out because it's hard to predict right now when the Fed is going to start cutting rates. It may not even happen this year. So we have to keep an eye on that. Then we have, of course, the earnings, which are scheduled for 7th of June. That would be something that could move the stock as well. I've mentioned as well the reports from the RVIA. That's something that we'll have a look at in May, June, July, and August. So that gives us potentially 4 before the short expiry. And then we, of course, have the commentary on industry events. So that's something we're going to have to keep an eye as well. Is there interest? Is there attendance? Is there consumer interest? That's something we have to keep an eye on. In terms of risks, we have to monitor if they plan to buy more companies. That's something that they've done quite successful in the past. They haven't announced any recently, but if they decide to purchase more companies, that would certainly come with the increase of debt in their balance sheet. And I think this is part of the reason why, despite all these things, the stock has been not punished as much as other sectors. Look at the movement here. There have been stocks out there that have been corrected much harder than this one. So if they start adding debt to the balance sheet, I think that can change quite rapidly. Of course, I mentioned the economy. We'll have to keep an eye as to the health of the consumer and how the economy advances from here. and energy prices too. And that's actually one bullish point that we can think about at the moment because if we look at, for example, how oil has dropped quite a bit in recent weeks, and it's certainly lower than in 2023, I think that's another bullish point for this stock at the moment. Now, May has been a historically down month for the stock, with an average of minus 2.5. However, the period from June to September has been overall positive in a streak. So I can show you this real quick. If I go to one of these companies here, okay. So the seasonality, visuals, and history. There we go. Monthly returns. So May typically down, and then June and July being rather positive. August slightly down to September being a really good month. So overall, with almost 7% average return. This is part of the reason why I'm choosing to go long September and short August. And so, okay, my price target, like I said, is going to be 120. The way I'm going to play this is as follows. I'm gonna buy. Just 1 second. I'm gonna buy 820 September calls and sell 16th of August 120 calls at the following prices: 253 and 173. From there, if we get to the price that I'm looking for, I get a return of 1.5 times more money. If we get to, say, a little bit more after the August expiry, say 125, I can get 6.5 times my money. And if we get to 130 after that expiry, I can make 12 times my money. So probabilities are good. The risk asymmetry is good. And there's plenty of time for this to play out. Even though I'm buying out of the money calls, if we have a good period as the months that I've shown you, I think it can go to those levels. In the meantime, depending on how next week develops and how this fits into my current portfolio, I'll put it on the watch list. If it turns good, I'll enter shortly. Thank you for watching. See you soon.